Good morning and thanks so much for tuning in. This is Stocks to Watch on BloombergQuint and I'm Mathew. My guest today is Mayuresh Joshi of William O'Neill. Thanks so much, Mayuresh, for joining me and good morning to you. Uh, I must say that, when the virus breakout happened and a lot of people said that we need a vaccine, people were skeptical as to how quickly a vaccine would come about. And we actually have significant progress that has been made by several companies. And the latest that we're hearing is that the efficacy of the Sputnik V vaccine is 91.4%. And in fact, the companies that are developing it say that the Sputnik V vaccine efficacy against severe cases of coronavirus was 100%. And that's good news for Dr. Reddy's, which is the first company that we're talking about today. What do you say in terms of how significant this development is for the company, and how do you play Dr. Reddy's?
Morning, Alex. Thanks for being on your show. So it's a positive set of news which has come through, specifically in terms of the efficacy that the drug is now displaying at this point of time. So that's positive news for not just us, I think, for globally in terms of the entire vaccination drive. So again, I think positively it should play out in terms of reported numbers going forward in the next few quarters. It will also have an element of added R&D expenditure for the Sputnik trials as well. So it was almost 9% in terms of R&D spend. Might go a tad bit higher. Albeit, I think the EBITDA margins will still probably remain in range between 24 and 25%. The US business, apart from this vaccine development, still remains a key driver for the company itself. It's close to 36, 37%. It's got a very, very strong pipeline in the US markets. It's almost 50 odd Para 4 applications, 2 NDAs as well, which means that the high margin products that you're probably looking about and the launches thereof are going to be critical. PSI, the India business, and the expectations in terms of biosimilar launches for the emerging market space. I think that is something that will keep the stock in terms of having a sustained revenue growth, margins, as I said, between 24 and 25% and sustainable ROEs between 16 and 17%. So largely, yes, I think a lot of positive developments surrounding the vaccine, but I think the business environment for Dr. Reddy's also looks sustainable and consistent moving forward. On our O'Neill ratings and methodology, I think the stock probably qualifies on most parameters. A clear disclaimer, we have suggested this stock a few months back to our clients, and clients would have been invested in this stock, Alex, based on our research reports.
Yes, and indeed they would have done well with this stock, having seen the kind of run that it has already had over the last few months. But let's move on to the second stock then, Kotak Mahindra Bank. It is a development from the point of view of the approval that RBI has given for the reappointment of Kotak Mahindra's chairman and top management. The RBI has granted approval for the reappointment of Uday Kotak as the MD and CEO, as well as for Deepak Gupta as joint managing director and Prakash Apte as part-time chairman. And the reappointment is for 3 years, starting the 1st of January 2021. So we are looking at quite a decent run, at least the next 3 years, Mayuresh, where there is clarity on top management for this bank. I think that might just have been a little bit of an overhang. What do you think?
Yeah, so I think there was elements of doubt on the entire part of the reappointment, so on and so forth. But I think with this, I think that partial overhang or headwinds for the stock are largely done with. I think the markets post this news will start focusing back in terms of the core fundamentals and what the stock has been delivering. Specifically in the past 2 quarters and what the commentary. So the commentary is very, very positive. I think the expectations in terms of disbursements and loan growth picking up in the next few quarters are expected to come back very, very strongly. So I think in the next 2 quarters, you will see a base getting created. And thereafter, I think tremendous loan growth expected back into double digits. Similarly, for deposit growth, I think deposit growth should be equally strong, which means that the kind of NIMs and spreads that the bank has been posting, they should be able to maintain that anywhere between 4.2 to 4.5%. Cost to income ratios have still been very, very manageable even during these tough times. Added provisioning, yes, required on the balance sheet, but asset quality deterioration was not that bad. So I think in terms of reported GNPAs, both gross and net, I think very, very manageable for a qualitative franchise, which reflected again in terms of cost income ratio staying below that 50% mark. Even if you presume credit costs to be 1 odd percent, 1.2 odd percent on a worst case scenario, I think the profitability and cash flows in terms of the core banking and ROE should remain strong. The subsidiary contribution also is quite reasonable as well. So if you look into account the life insurance business, the securities part of the business, the asset management part of the business, gives that optionality value as well. Valuations maybe a tad bit on the other side, but it fits again, as I said, on our O'Neill ratings in terms of growth and the EPS ratings and the parameters of the overall master score. Again, suggested this talk to our clients. So clients might be divested in terms of our research reports.
Okay, now speaking of valuations being tad a bit on the high side, we're talking about Berger Paints as of now, but I want to hear what you think about it. It's a stock that is now reaching about 52-week highs. No real developments in terms of news, but if you look at that line, and it's practically a trend line that's moving almost in one direction as of now from May onwards, apart from a bit of a correction just around the end of June. But are these justified? Are we really likely to see that pick up? Of course, the latest could be around the movement that we've seen in the recent past about crude, but with crude having stabilized around that $50 per barrel mark, it's not really cheap per se. So what is your view on Berger?
Oh, so no two ways about it. Definitely not cheap. Valuations are really punchy in this case. But I think the entire logic and the rationale behind paint stocks doing well, demand expected to come back. And the numbers, I think the numbers were outstanding in the quarter gone by. So good amount of volume growth. The management commentary was very, very positive in terms of rural, semi-urban growth picking up and even the urban growth picking up for the decorative segment as well. So paint companies normally work on two functionalities. A, how the volume growth is expected to be, which is a direct correlate to how the GDP is expected to move. If GDP is expected to improve in the next fiscal quite significantly, volume growth normally happens 1.5 times. So expecting the consistency in terms of double-digit volume growth for paint companies to continue. Yes, crude is moving higher, but I think the flexibility that they've got in increasing prices, and if demand is sustainable, as the management is saying, I think the kind of margin performance that they gave out, the volume performance and operating leverage that gets created results in better cash flows, reduction of debt, which has remained stable in Berger's case around 550 odd crores. So tier 2, tier 3 rural, I think that is where the pickup is expected to be. Cost optimization happening, expectations in terms of margins expected to remain stable around 20%. I think those are all the factors creating the kind of move that you're probably seeing in the stocks. No two ways about it. Valuations are extremely punchy. But if earnings are going to come through at a good pace, I think markets might still keep on looking at the stocks. We might keep on holding the stocks, but again, I think as per our methodology, keep a view in terms of where the 50 DMA line is, because that is a very, very critical support for the stock. And if the markets start turning, I think most of these high beta stocks can also come down. So I think can hold, but watch out for the 50 DMA line as per our methodology.
Thanks so much, Mayuresh, for joining me and for sharing your views. As always, it's a pleasure speaking to you in the morning.
Thank you so much.
And to you, dear viewer, thank you so much for tuning in as well. We've got 3 interesting stocks that we've spoken to you about, but there's lots more that you will read and view on the website, BloombergQuint.com. So don't forget to check it out over the course of today. Thanks so much for tuning in. Have a great day.